in the middle of a busy trading day. Before we go into Q3, I just thought that I'll quickly recap what we're trying to do as an organization. We are in the process of uploading our investor presentation for Q3. We seem to be facing some little technical hitch in that context, but we should get it done in the next 5 or 10 minutes, and hopefully you'll be able to see it before the end of this call, and we can probably ask a few questions about using that as context as well. We've added a couple of slides in the current investor deck. The last time we had met, I said that we will sort of show to you how our portfolio looks from the point of view of security coverage. That slide has been added, as have a couple of other slides that talk to our company and its strategy. So coming back to our strategy, we wanted to build a granular book. We wanted to grow our retail and commercial assets, which tend to be smaller ticket, which tend to be more predictable, more statistical in the way they perform. That does not mean that we wanted to get out of corporate business altogether. We just wanted to grow the other two pieces of our business faster, and as a consequence, reduce the overall share of our corporate book. That was our major driving force as far as strategy was concerned. And we've made reasonable progress on that front, and we will come to that when we look at the Q3 results. The other items, our liabilities book is largely retail, and I think that gives us a great opportunity for growing our retail asset book, and that is something that talks to the strategy that we've articulated earlier on the granular asset book front. We want to move from paper to digital. We've made significant progress on this. We are in the process of creating a new digital environment that will enable us to do real-time underwriting in a paperless ecosystem. Our first set of products, which is essentially retail and commercial, one retail product and one commercial product, are nearing a testing kind of level. And once we've ironed out all the glitches, we should be rolling that out reasonably quickly. And once the first set of products are rolled out, we hope to roll out progressively the full range of retail products and also a limited set of commercial products that are amenable to algorithmic underwriting. We want to move from purely judgmental underwriting to an algorithm stroke plus judgment kind of environment. We've now developed scorecards for both retail as well as commercial. Each product requires a particular scorecard to be developed, so our first set of scorecards for the first set of products are available, and we are in the process of integrating them into the new digital environment. This will enable us to move into a new method of doing business, reduce paper, and also increase the speed with which we can turn applications around. And we believe that we are uniquely positioned to take advantage of the growth on the commercial side, because we have a fairly large commercial book, and we have data which perhaps is not available to other lenders, which will enable us to create more discerning scorecards than other bankers can, and that process is well underway. We are also working assiduously to create a world-class risk organization, and there's been reasonable progress on that front as well. Our centralized collection unit is now operational. It's not collecting on the entire book that we have. It is currently focusing on items in SMA 0 countrywide, and over time we hope to move on from just covering the retail book to covering the commercial book as well, or parts of the commercial book. So that's the overall progress. I'll now move to the quarter that has just gone by. We continue to grow our branches. We are now up to 773 branches. From a business standpoint, our assets have grown reasonably nicely. we grew 17% year-on-year. Corporate grew 11, commercial grew 18, agri grew 20, and retail grew 18. This enabled our mix to become more granular. You can see that the share of corporate has now dropped to about 32%, and share of commercial has grown to 34%, and the remainder is now split between retail and agri. Revenues for the quarter grew 14% year-on-year. Net interest income grew about 8.5%. The other income was exceptionally buoyant. It grew 32% to 225 crores. So on an aggregate basis, revenues grew 14%, expenses grew 3%. I want to caveat it here in the sense that, when we last spoke, I did mention that we are seeing sequential, we did see from quarter 1 to quarter 2 growth in expenses, and we are now seeing from quarter 2 to quarter 3 growth in expenses, and that is something that we are addressing as a management team. Taking all these numbers together, our operating profits were up 26% to 421 crores. And we created provisions of 325 crores, of which 306 crores were credit related, and 19 crores was non-credit related, which led to a profit before tax of 96 crores, taxes of 25 crores, and a net profit of about 71.5 crores, down 38% year-on-year. The numbers have been impacted by significant NPA accretions. Total NPA accretion was 638 crores, of which NPA arising from corporate accounts was 580 odd crores. The corporate book is, if you were to measure it as NPA accretion divided by end of period balance multiplied by 4, the rate at which NPA is accreting is approximately 16.2%. Commercial accreted by 59 crores, which is roughly a 1.5% accretion rate. Retail did not accrete. In fact, we had negative NPA on retail, and agri, we had a marginal increase of 1 crore, which is, in percentage or basis point terms, negligible. So we continue to have, from a credit quality point of view, one portfolio that is providing stress, and it is something that we are working on. Last quarter, when we had been on this call, we had mentioned that approximately 1,200 crores worth of assets were on our watch list. Of that 1,200 crores, 550 crores is now classified as NPA, which means that a little over half of what we had identified as stressed assets have now been classified as NPA, and the other half we expect to go through between this quarter and the next. So the net interest margin remains buoyant. It was 3.71%, dropped 10% sequentially, but some of that drop is on account of the fact that there were very substantial interest reversals on account of the elevated NPA recognition. And on a year-on-year basis, net interest margin actually went up. So as we make our portfolio a little bit more granular, I think are seeing that we have some amount of pricing power, and we intend to continue with our current strategy, which is to focus on commercial and retail and agri, and that doesn't mean that we are not going to do the corporate business, but try and grow the other three faster than the corporate business, such that we build a book which has characteristics which are significantly different from the one that we have today. So with that, I'd like to open this up for any comments, questions that you may have. My colleagues and I will try and answer them as, with as much detail as we have in our possession. Thank you very much.
Thank you. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touch-tone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We will take the first question from the line of Nagraj Chandrasekhar from Laburnum Capital. Please go ahead.
Thank you very much. 2 questions. The first is I appreciate your clarification that the book going forward is going to look very different, than the book does right now. Could you elaborate a bit on how you plan to build this book out? Because, on the SME side, obviously we have a historic franchise and, strong relationships in our core geographies. Having said that, the market is intensely more competitive than it's been in the last, many years, even decades. So although we have a strong heritage and a strong ability in lending in this area, in the face of intense competition, I'm curious what your strategy is for building out the book and also what kind of yields you'll be underwriting to when you build out this portion of the book. The other area that banks are looking to grow in as they go away from corporate is retail, and that is even more competitive. And given that, we don't have a very high CASA ratio, I'm just curious, when you talk about transforming the book, what is the outlook on yields? What does that translate to in terms of the ROEs you'd be targeting? And what are the operational changes you'll need to put in place to actually build this book out?
Thank you very much for the question. I think it's a very, very good question, and it sort of outlines the challenge in front of us. What we are attempting to do is reasonably challenging, and as you rightly mentioned, we have certain embedded strengths, which is on the commercial side, which we don't really possess on the retail side. Having said that, on the retail side, we have about 7.5 million customers to whom we are largely providers of transactional banking. And our aim initially is to try and deepen that relationship and make them asset customers as well. If you were to look at our total asset book, it is around 7,000 crores. I'm cognizant of the fact that you haven't got the investor deck. So in the investor deck, there's a whole bunch of other details. So the 7.5 million customers give me the opportunity to grow from 7,000 crores, without having to face very, very significant competition. I mean, at least they are an addressable population. I know where they are. I know their telephone numbers. Our ambition is to basically double from our current level in relatively short order. And to do that, we need to change our processes. Our processes today are paper-based. They are judgment-based credit underwriting. So we are creating a new environment, and we've made reasonable progress in creating a new digital environment where we can underwrite eliminating paper almost. It's always difficult to eliminate paper completely, but the decision-making processes can become significantly more electronic. The new environment is plugged into various sources of information, so we can access a whole bunch of fintechs that provide a whole bunch of information that's useful from an underwriting standpoint, and it's coupled with a reasonably predictive scorecard. And that is a very, very big change in how we do business. How the system adapts to the new environment is something that we don't know yet because we haven't launched it. And once that is launched, we also will like to change our sales architecture a little bit so that we can reach out to our customers effectively. So that's the retail bit of the strategy. The commercial bit is, again, broken up into 2 parts. On the one hand, we have about 20 or about 80-90% of our total book is actually small ticket commercial loans, less than 1 crore of rupees, and that book is amenable to underwriting using algorithms. And very surprisingly, our scorecards on that front are even more predictive than the scorecards that we have for the retail side, which is quite surprising actually. I've not seen them before, and we think that with those scorecards and given the wealth of information that we have, we should be able to make a loan to a commercial customer where we take perhaps a week or 10 days today, we can cut it down to a day, and we can do much of it without the use of paper. And once that system comes in place, we think our ability to actually go ahead and seize market share in areas where we are an embedded institution will be very considerable. And that's what gives me a little bit more confidence that these two pieces of our strategy can work.
And just one follow-up to that, given the changes you're seeing in the public sector banks, and we now have a little more color on the government's expectations from these banks, is there room maybe on the SME side or the mid-corporate side to be taking share from these banks as they focus more on retail? So, think of the second-tier PSUs in your ecosystem. Is there room to kind of build out a high-yielding SME or mid-corporate portfolio by just taking share there?
There is definitely room to do that. The way the PSU banks behave is not uniform. The same PSU bank in one location behaves differently from the same bank in another location. So some places, they seem to have not got the message whilst in other locations they've got the message and they've refocused. But we are seeing a reasonable amount of business that is coming in from the PSU banks, and that's what's been helping us grow the commercial book. And from a pricing point of view, I think the changes that we are implementing today with respect to the new scorecards will help, because it will enable me to identify higher risk customers in a more scientific manner, and therefore try and price them differently. And it also gives me the ability to put in systemic controls on the pricing. So once that is done on the SME side, we think prices, the spread should sort of go back to a reasonable level. As I mentioned in the last call, our aim is to grow at market. The book should grow at market, but we want to be priced for risk, and we want to get a reasonable return on the risk that we are taking, and which means that we want to have spreads which are higher than the market, which in turn should lead to faster revenue growth. That's the business strategy that we'd like to adopt, and I think the steps we are taking will help us, in part, achieve that.
Thank you.
Thank you. Before we take the next question, we would like to remind participants that you may press star and 1 to ask a question. The next question is from the line of Sanket Chheda from IDFC Securities. Please go ahead.
Hello.
Yes, Sanket, go ahead.
Yes, sir. Could you please repeat the slippage number and the bifurcation between corporate and commercial?
Sure. The total slippage, let me just find the exact page for you. It's there in the deck. When you see it, you'll get it. Corporate total slippage 638 crores.
Okay, and 580 is corporate.
Yeah, 581 corporate, 59 commercial,
Okay.
one agriculture, -2 retail.
Okay, and sir, I got this. In the total watch list of 1,200 crore, you are saying that around 550 has been recognized in this quarter.
That's right.
Now, balance 650, how much of that you expect to slip in over the next 2 quarters, or you say 80-90% is expected to slip, or how is it?
No, we think that the whatever needs to slip will slip within the next 2 quarters. It's difficult for me to predict, other than to identify those assets which we think are stressed, to actually predict the timing when the NPA will be taken. So one other point that I want to make is that all NCLT assets, all cases where they have been referred to NCLT are now classified as NPA on our books.
Okay. What would be the SMA-2 number?
SMA-2 number I don't have at this point in time, and I'm not at liberty to actually give you, even because those have not been checked. The investor deck is now on the site. I do apologize for the delay it has taken. The delay in uploading it. So if you could bring it up, you'll see a whole bunch of information that is very helpful, and it'll also sharpen the questions that you ask, I guess.
Okay. So would SMA-2 number would be there, or?
SMA-2 number is not in that on the deck.
Yes, there is a dynamic number. It keeps on moving.
Okay. Any ballpark number would be helpful.
See, it will be in the normal ranges, and it keeps it will be dynamic number, and it is well under control. That much I can tell you.
SMA-2 numbers, you will appreciate, given the fact that we've taken 638 crores of NPA. SMA-2 is a declining number because the NPA accretes from SMA-2.
Okay. Okay, sir. That helps. Thanks.
Thank you. We will take the next question from the line of Shekhar Singh from Excelsior Capital. Please go ahead.
Yes, I just wanted to know, you mentioned 1,200 crore worth of assets were on the watch list. Now 550 crores has been classified as NPA. And what happens to the remaining 650? What is your view on that?
My view is that whatever NPA we have to take will happen in the next 2 quarters.
Okay, so in the sense of that 650, whatever is you think will become NPA will get reported in Q4, huh?
It will happen in the next 2 quarters. I mean, between Q4 and Q1. Yeah, it'll, whatever needs to be taken as NPA will go.
Okay, and as per your estimates, how much of that will go into NPA?
How much of that will go into NPA? I mean, we are working, from my point of view, you plan for the worst and hope for the best. So on that principle, the worst that can happen is 650 will become NPA, boss.
Okay. Okay, sure, sir. Thanks, sir.
Thank you. We will take the next question from the line of Anand Laja from HDFC Mutual Fund. Please go ahead.
Hello, sir.
Yeah, Anand.
Sir, if you can give some color on the provisioning cost, like how much of provision now we carry on the NCLT related cases, and also on the overall coverage, like what's your thought, what sort of coverage ratio you wanted to maintain?
So currently, we are, if you were to use the RBI definition of coverage PCR, we are running at about 54%, unchanged from the last quarter. If you look at page 34 of the deck, it tells you how much provisioning we've done this quarter. NPA provisions have increased by 348 crores. There is a reversal of an NCLT standard asset provision that was being held by us to the extent of 48 crores. We've got 3 crores of standard asset provisions, and we've got 2 crores on restructured asset provisions. In addition, we've got about 19 crores worth of provisions made for diminution in value of investments. But on the On the credit side, we've created roughly, let us say, 306 crores worth of provisions to cover the flow that we've had into the NPA so far. I mean, I'm sort of netting off the 48 crores of NCLT provision. Yeah. So on a computed the way you normally do, which is basically total gross NPA versus the coverage that we have currently, it works out to 34.89%.
Right.
As against 32% in the prior quarter. So we've inched up to about 32%. So the strategy now is to have the corporate book, the lumpy bits which will flow through into NPA over the following 2 quarters. Post that, our provisioning will continue to remain a little elevated because we will need to improve this PCR from our current levels. So that's the view that we have at this point in time.
So, like, what level of provision coverage you will be comfortable? So, like, today you are at 36%, probably a level of 50%. Would that be comfortable for you? And this is what you can expect in over the next 4 quarters or next 5 quarters. You can expect that level to come in. Would that be a fair assessment, sir?
I'll be honest with you, Anand. I haven't spent my time thinking through that so far as to what level. I mean, obviously, the coverage ratio that we currently have at 32% is something that 34 or almost 35% we wish to improve. How we do it and how much room we have and when we will hit the levels that you were mentioning, which is i.e. 50%, is something that I haven't spent time thinking through. Maybe in the next call I can give you a specific view on that. As of this moment, I would not like to speculate because we've not really, as an organization, spent time on that so far.
Okay. Anand, sorry to interrupt. Anand, Prasad here. See, earlier you remember historically we were maintaining a PCR of 75% as per the RBI guideline.
Right.
Okay. So now we are also looking at the market calculation of how we are doing. So our attempt would be to see that we go back to the original numbers. Automatically, over a period of time, whatever you calculate on a market basis, that will also reach the numbers that what you are expecting. But the period is to be decided. It will gradually that will go.
So if you have the deck in front of you, there is one slide I would like to draw your attention to. Where is that slide? Slide 23. If you could move to slide 23. You will notice that, in the last call we had said that we are a traditional lender and that whatever we do, we tend to have real security available to us. And what we've tried to provide in slide 23 is the form of security that we are holding against our loans. The unsecured bits of our loans are very, very, very small. So whilst we are having default, our contention is that loss given default, the absolute loss given default will be smaller than it will be for other banks who operate with a book that is significantly more clean, in the sense without security, than ours. So I hope that sort of provides a little bit additional color for you.
Anand, could you locate that slide, Anand?
Yeah, I can look at.
Security coverage.
Yeah, yes, sir.
We have put, tabular format. Where the gold loans, then all the real estate property, how much this is covered, everything has been there. You just have a look at it, Anand.
Perfect. And so lastly, on the treasury side, if you can give some color, like how much excess SLR we are holding, like how much SLR we have in terms of as a percentage of NDTL, and till what yield we are protected.
See, from our point of view, we've in this current quarter, we got 25 crores worth of profits from sale of investments, and we recognized 19 crores worth of diminution in value of our books. So net we were up 6 crores. If you look at page 26 or 27 of the presentation, it gives you some detail of the book that we are holding. We are significantly below the investments that we were holding in December of last year, and slightly above what we are holding in March of this year. You can see that the yields have dropped from about 722 to 701 between March and December, as we've taken some amount of profit during that period. So I am unfortunately not having the, what is our SLR number, HTM number, etc. Yeah. So I mean, from a non-SLR basis, we are not holding a very large number. Let me say that we are holding roughly 15% of the total outstandings as of December as non-SLR securities.
Perfect. No, so actually, I just want to understand how much excess SLR we are holding above the regulatory requirement.
We have been quite prudent, and we didn't know which way the rates were going. So whilst initially there was some amount of willingness to take a bet saying that it will reverse, when the rates started hardening, we very quickly realized that we didn't really understand which way this thing was moving. So we sort of cut back on our positions.
Perfect. And so lastly, what could be the outstanding security receipts we will be holding, and how much provision we have on the same?
We had told you last time around, the numbers were given on the last call. We were holding approximately 500 crores worth of security receipts. It's on the same page. 496.04 crores worth of security receipts are being held on page 27, on which we are holding, reasonable amount of provisions as well. So this is the gross number.
Thank you. We will take the next question from the line of Bhavik Dave from Reliance Mutual Fund. Please go ahead.
Hello.
Yeah, hi.
Hi, sir. I just wanted to understand, you alluded in the opening remarks that your other OPEX has been on an increasing trend. So can we understand what exactly is leading to this increase in our other operating expenses?
Basically, three factors leading to higher operating expenses. One is there's been a branch rollout that has taken place. You can see that our branch count has been rising quarter on quarter. So over the last year or so, we built up 100 branches, and that will cost money. There's been an increase in headcount. So we are now 8,000 people, 8,060, I think, if my memory serves me right, strong, up about 800 people between now and the same time last year. And that again increases costs for us. And finally, there is this cost that is coming through on account of wages that are increasing. I mean, with the IBA settlement, which is underway, is expected to cost us more, and we are anyway paying an ad hoc amount of 10% incremental. Instead of provisioning it, we're just paying it out. Historically, IBA settlements have been more than 10%. So that sort of seems to be the best way of handling that. Finally, we are investing in some technology to create a bank which is more digital, more synced up with the information sources that exist today, so that our decision making can be faster, can be more appropriate to the situation under question. So, we've sort of signed up with a whole bunch of fintechs who are supplying us with information. We've signed up with a whole bunch of bureaus, and we are creating a new loan origination system, so that we transition from our current loan origination system to a new one, which will enable us to do business much better. So that the technology bits are adding to a little bit of cost. So these are the drivers of the cost increase. And the whole team here is fully seized of the fact that cost is something that we have to manage in an environment where revenues, whilst they've been buoyant thus far, given the fact that interest rates are moving upwards again, there will be some pressure on the revenue front. So we need to manage that, and that is something that we are working on.
Sure. And sir, one more data point that I would require is in a quarter. Yes, sir.
Bhavik, Prasad here. See, as MD has mentioned, normally, we are charging off to the P&L as far as this wage increase is concerned.
Right.
Okay. So, around 10%, though settlement is far away. And like last year, we have been paying off to the people, and that is already debited to the P&L, and it is already factored, Bhavik.
Sure. And sir, on the other expenses front, what would be a quarterly cost or a yearly cost for technology that we are spending on IT? Any broad-based number?
The IT costs are, not given our total cost base, which is roughly about 1,600 crores
right
on an annual basis.
Correct.
I would think that the incremental cost is, about 1% or thereabouts. So it's not that large. Huh?
Okay. And sir, one more thing. You mentioned that we are moving towards these scorecard models and algo-based underwriting for retail. But if I see during the quarter, has this been implemented because our personal segment growth, which is a decent-sized loan book, has not been growing that well. So are we still we are in the stage of pilots on this front? That is the reason the growth is slow, or what is it? What is causing this growth to be tepid?
Yeah. So we've grown from 6,093 crores as of 31/12/2016 to 7,366 crores as of the end of December this year. Okay.
Right.
Roughly 21% is what we paid 19 reports of the analyst deck. But that includes 200 crores worth of assets that are in the form of an IBPC. So effectively, our growth is approximately 18%, as I told you in the beginning of the conversation.
Right.
So 18% is, whilst the number looks reasonable, on a small base, we've got 18%, and that's the point that you're making, saying that your growth is not fast enough.
In the one specific segment, that personal segment loans on slide 22nd, there's this line item which shows personal segment loans, which is a granular loan book that we're talking about, and that's where the scorecard models and all the initiatives that we're taking will be implemented.
To answer your question, the scorecard model is not yet live.
Okay.
They're in the process of being implemented and made live.
Okay, that is what I wanted to understand. Yes, sir. All right. Thank you.
Thank you, Bhavik.
We will take the next question from the line of Parag Jariwala from White Oak Capital. Please go ahead.
Thank you, sir. What I want to understand is basically the watch lists which you have given. Does it include all sort of restructuring like SDR 525 or probably the standard restructuring, or those numbers are separate? And if they are, can you just give us those figures?
The watch list that I have given is the sum total of what we think are assets at risk in the near future, right? So when we created the watch list, we said, hey, what is likely to go down the tube in the next 9 months? Because anything beyond that, we don't have visibility to actually. So it's very difficult to do anything other than to create a watch list of assets which are likely to become non-performing in the near future. So that included both standard assets and those that had been restructured. So right now, we have 650 crores out of the 1,200 crores, which is still on our books as performing assets. Out of that 650 crores, roughly 340 crores has either been restructured or is SDR or S4A.
Okay.
Okay?
Okay. Thank you so much.
Thank you.
Thank you. We will take the next question from the line of Dhaval Gara from Sundaram Mutual Fund. Please go ahead.
Yeah, hi sir. I just saw the gross slippage during the quarter was about 713 crores. Could you give the slippage gross basis? I mean, I understand the net number you have given of 581 and 59, which is there in the investor deck. Could you give the gross numbers?
So, can I do that in the next presentation that we make? I mean, we can give you the information.
Yeah, sure, no problem, sir. I'll take it offline. That's fine.
It is
The
like
second, yeah.
32.
Sorry?
So here is the gross slippages. 30.
Prasad here.
Yes, sir.
See, you have 713 crores. Okay, 713 crores minus the 86 crores that what we have shown, and minus the technical.
No, he wants that 713 broken up by category.
Yeah, like corporate, retail, and commercial.
I can give you the next time around.
No, sir. I'll take it offline. No problem, sir. The second question we had was, sir, some of the changes that you are talking about on the scorecard and on the underwriting and on the risk framework. I mean, how much time do you think it will take to sort of see the full benefit of all these initiatives? I mean, if you had to take a sort of calculated guess.
I hesitate to give a specific deadline because I've been told by my company secretary that I cannot. So the fact is that we have made very, very significant progress on both of these, and we believe that the first set of products we are quite close to launching, or at least testing out and then launching.
Right.
And the thing is, this is a company that is used to doing business on paper.
Correct.
The challenge that we are going to have is to get people to start using the new technology.
Right.
How long that will take is something that we will find out once we start launching it, and we'll have to be reasonably creative in how we sort of move people from one environment to another.
Sure, sir. Sure. And okay, fine. And just lastly, sir, on the CASA growth front, so while I understand, the YOY numbers may not be correct representation, but in general, are you sort of satisfied with the way we are creating CASA on an absolute basis, especially from March? Or do you think, or are we taking some initiatives to sort of improve this trend? I mean, some color on CASA.
You're right. We're not satisfied. We're not particularly happy with CASA. We are putting enormous focus on building CASA. We are in the process of launching a couple of technology-enabled products on the CASA front as well, but that is in the future. It's an area that we would like to improve. I mean, currently we are in the 27-28% kind of range. We need to move this to 30-35 reasonably quickly, and this is something that we are working on. I don't have any specific action plans that I can report to you which have made substantial progress. So, but it's something that is an area of focus for us.
Sure, sir. Just last one data point I need. What is the net worth at the end of third quarter?
Net worth will be close to about 6,000 crores is net worth.
It is there in the page, where the CAR calculation is there.
Is it? Okay.
Yeah, of course,
it doesn't have...
Yeah, these profit numbers for the 9 months.
Huh.
Okay.
Oh, fine, sir. Fine. No problem. Yeah, thanks. Wish you all the very best. Thanks.
Thank you.
Thank you. We will take the next question from the line of Ravi Singh from Ambit Capital. Please go ahead.
Sir, just to understand this watch list a little better, last quarter you gave watch list of 1,200 crore, out of which 650 is still standard, roughly 4-5% of corporate book. And you said at that time it was your subjective assessment based upon expected slippages. So since that last quarter, has there been any deterioration in the other standard loans? And what do you think is the probability that at the year end, probably when you revise your watch list, there could again be a substantial number at the risk of turning NPA? Or to put it differently, will you be revising your watch list again at the end of the financial year? What will your approach be towards the entire watch list concept?
So as of this moment, we don't see any reason to revise the watch list. So there's no information that indicates that our slippages would be, or there are material accounts that need to be added. So we are sticking with the 650 crores at this point.
Okay. Thank you, sir.
Thank you. We will take the next question from the line of Pranav Gupta from HDFC Securities. Please go ahead.
Hello.
Yeah, Pranav, go ahead.
Good afternoon. I just wanted to ask two things. Firstly, in terms of retail loans, so if you're looking to build out retail book quite quickly and putting analytical tools in place, what are the segments that we're looking to focus on, and what kind of growth do you see in those segments going forward?
We would, historically, our growth on retail has been reasonably tepid. We want to start growing this aggressively, but we need to put in place the mechanisms to grow. So right now, we don't have the tools to underwrite them quickly. So once the tools start coming on stream quite quickly, once they come on stream afterwards, we want to restructure our sales force and then go after these customers in a big way. So hopefully, over the next 18 months or so, our aim would be to move from where we are today to something like, we would like to sort of double this. I mean, we are a very small book. I mean, if you look at it, we are 7,000 crores, which is in the context of India today, we are not a particularly large book in any case.
No, sir.
And we're very diversified across products.
Right. No, just to get a sense on what products you're focusing on from here on, because if you say that you're setting up scorecards for a couple of products, what products would those be? And
so we are starting with the housing loan product.
Right.
The first scorecard that we will have will be housing loan. We will then, concurrently we will work on a scorecard for vehicle loans and one for two-wheeler loans. We have a small two-wheeler book which performs very, very well. And that we will sort of deploy on other durables as well. So since we have very large presence in tier 2, tier 3 markets,
right,
with the tools in place, I can effectively underwrite the way an HDFC or Bajaj Finance will be able to underwrite in the same amount of time. And it's just that these markets are closer to me than they are for those entities. So we intend to sort of play in that space. And that will start. The first set of automated underwriting tools will roll out soon, but then as we sort of get the new tools in place, that will take a little bit longer. So we have a map of when what is going to go live, but I am a little hesitant to give you that specific timing in this call.
Not a problem, sir. So secondly, so you said that, if we see that, we've been aggressively rolling out branches over the last 1 year. Going forward from here, given the focus on technology-enabled growth, how do we see our branch expansion plan panning out, and probably for the next year or so?
So we are not going to aggressively open branches in the future. Whatever we had made commitments for, we are completing. So in the future, we will be realigning our branches, which is, an unperforming branch move to a better location, that kind of stuff. Our focus, wherever we are opening a new branch, we would open more in our core markets, which is Tamil Nadu, Andhra Pradesh, Telangana, Karnataka, and belt. We are in the process of reviewing our branch network very closely. But as a matter of principle, we want to rely more on technology and digest these branches that we've opened. We've opened a whole bunch in over the last 2 years. We want to ensure that they become productive. So the next year, our strategy is to go slow on branch openings.
Okay, sir. Thank you so much, and good luck for the coming quarters.
Thanks. Right here.
Thank you. We will take the next question from the line of Amit Premchandani from UTI Mutual Fund. Please go ahead.
Yeah, Amit ji, hi. Hello, Amit.
Amit, if you have self-muted.
Hello. Yeah, sorry.
Thank you.
Yeah, Amit.
Yes, sir. How are you, sir? Good.
Fine, yeah. Go ahead.
Yes, sir. On the fee income front, this quarter has seen a very sharp jump in fee income, and that has been a trend for the year 9 months also. What exactly is driving this sharp increase in fee income? Although that is not reflected in the profit numbers because of provision, but can this trend be sustained?
It's a very good question, Amit. There are 2-3 areas where fees have grown, and in this particular quarter, we had, our insurance sales numbers went up quite dramatically. We had very significant excesses in our priority sector lending book, which we placed out as PSLC, which earned us a reasonable amount of money. And that didn't exist. Both of these didn't exist in Q3 of the last year. And as a whole, the fees and charges, fees and commissions that the institution has been charging has been realigned to ensure that we get adequately compensated for the services that we provide. So that has led to very robust growth in fees, 32% year on year. We think that there is a lot of room for us on the non-interest income side, especially with third-party products, which we've not been pushing very aggressively, to continue to grow that. And we think that there is substantial runway left on this front. Now, whether this is repeatable quarter on quarter or not is something that we sort of worry about. But having said that, it is something that we think has a lot of runway going forward. On page 11, there's a breakup of fees. You can see that the category called others, which is where insurance and other such products have been sort of lumped, is growing quite nicely, and that's we are significantly underpenetrated. I mean, our total throughput is much smaller than other comparable banks. So if we were to just catch up, we would be having very significant growth in our revenues.
And sir, who are your insurance partners?
Right now, our insurance partners are Birla Sun Life and Allianz, and we are in Bajaj Allianz, and we are in the process of taking advantage of the new rules that enable us to have multiple partners, so that we have a full suite of insurance products. And that is before getting into the wealth management space. I mean, our investment distribution business is very, very limited. So there's the next opportunity is to get into some form of distribution of investments, which is something that we are beginning to work on right now.
And can you help us quantify the PSLC fee income book this quarter and this year?
I mean, it's out of the total income for the quarter. It's about out of the total income, roughly about 3%, I would say, of other income is PSLC related income, 3.5%.
And sir, final question for me. Recently, we have been requested to vote for a resolution for change in the ESOP plan, without any reference to the price of at which ESOP will be issued from an investor point of view. I just want to understand your thoughts about how much discount you are planning to give when you issue ESOPs, and are you attracting a lot of talent from the market for which you require this change in ESOP plan?
Thank you for the question. It's a little difficult for me to answer because I'm conflicted on this one. I am likely to be one of the beneficiaries of the ESOP plan, or at least I hope I am. The ESOP, current ESOP structure limits the total quantum of ESOPs that can be granted to 10,000 shares or with a face value of 10 rupees, which is roughly, under the new context, to 50,000 ESOPs. And that, the view was that is not appropriate in the current context, and that we needed to attract talent that can take this company, take this bank into the future. And which is why the new scheme was merely a modification of the older one by just changing that one, removing that limitation and putting the SEBI limitation of the total maximum ESOPs permissible to one individual. So it's the old plan changed to only reflect a regulatory maxima. Now, coming to the risk that exists in that the current plan does not put it does not put a price at which the ESOPs will be given, and which technically, therefore, gives the institution the ability to give a share at par value or at current market price, somewhere in between. And if they give it to employees at par value, it is something like 98-99% discount to the price in the market. That risk is the one that I'm sure you are sort of grappling with. Our answer to that is ESOPs are granted by the institution after the Nominations and Remunerations Committee sort of approves them. The Nominations and Remunerations Committee is a committee of the board consisting of 4 independent directors and 1 promoter director. None of the executives are members of the Nomination and Remunerations Committee. The company has historically been very, very responsible in how it has given its ESOPs. So far, it was permitted under the resolution of 2011 to issue ESOPs of 20 million ESOPs. It has only issued 6.22 million so far, and the last time ESOPs were issued was in 2013. So 4 years have elapsed since the last issuance, and 13.78 million ESOPs are issuable under the old scheme, which was duly approved by all shareholders. The last time ESOPs were issued, it was definitely issued at a discount. It was issued at a discount of approximately 40%. But that was under the, I'm sure the Noriko at that point in time took into account the facts on the ground, and why such a discount was given is something that I don't really know, because I was not in this organization at that point in time. But what I would like to stress to you is that this is a responsible organization. It has not issued all the ESOPs that it could, even under the older regulation. It has last issued ESOPs in 2013. It is currently trying to transform itself into a more modern, more contemporary institution and move into the digital world. It is seeking talent today that can help it make that transformational journey. And today it requires the tools by which it can actually attract talent and ensure that this transformation can happen. So I think from my point of view, and I repeat that I am conflicted. From my point of view, this is something that the company needs to do and would like to do, because it is absolutely imperative for success going forward. It is a responsible company, and it has used the powers that have been delegated to it by the shareholder responsibly in the past, and there is no reason why it should not in the future. So that's the best answer I can give you, Amit.
Amit, this is Prasad here, CFO here. MD has put it, in the perspective of how the organization has behaved in terms of the ESOP for the last 4 or 5 years. The fact being that 13.78 million options are still pending and not granted. And also, ultimately, organization would not like the bottom line to be hit very bad. So it's only it is a good balance that we want to have between the retaining the talent and as well also to attract the talent and also not to be far away from the market. Okay, so this is the reality, and you can judge from the behavior of the organization in terms of allotment of the ESOPs in the last, in the previous years. Okay.
Sure, sir. Have you hired anyone in the top management post the hiring of the CEO? Any new additions have happened?
No, we are in the process of hiring our Chief Risk Officer. And that's the next big hire that we are planning to do. And that is very far advanced at this stage.
Thank you, sir. That was very comprehensive. Thanks a lot.
Yeah.
Thank you. We will take the next question from the line of Dhaval Gada from Sundaram Mutual Fund. Please go ahead.
Yeah. Hi, sir. Just a couple of data points. What is the PSLC income we've earned in the last 9 months?
Not in the 9 months. Was the first time we actually did a PSLC transaction was last quarter. For this quarter, actually, Q3.
Okay. And the amount you said was about 58 crores, right? 58 crores.
No. We made PSLC income of roughly 3% of other income, 3.5%.
3% of other income. Oh, okay. I think you said total income earlier. Sorry. Okay.
No.
Okay. And sir, the RBI audit got completed last time and you were awaiting final report. Any update there?
The RBI audit is still underway. So we will get our first report next week. Their initial observations will be made known to us next week, post which we'll have our closing meeting with them. Before that, obviously, we'll have some discussions, etc. So as of now, they've not updated us on their salient findings, with any.
Sure. And just lastly, sorry.
Last time, when we told, we were expecting them to come early, but they came late. So they are still here in our office. Yeah, they are still in our office, and they know next week they'll be closing.
Sure, sir. And sir, this just to double confirm this, the 650 crore watch list that is there pending, it includes SDR, 525, and S4A. And what percent of the restructured book is already there in that watch list, sir? The standard restructure, which is not.
Out of 650 crores, 340 crores is either restructured or SDR or S4A.
340 crores. Okay. Fine, sir. Fine. Thanks.
Thank you. We will take the next question from Rahul Maheshwari from IDBI Mutual Fund. Please go ahead.
Good afternoon. I have 2 questions on your page 40. On investor slide 40, on a 7-year basis, if we look at profit per employees, it's at one of the lowest at 4.88 lakhs. So is it we are at the worst kind of thing, and when can we can see the improving productivity on that front and also on the business per branch, because we are at an all-time low kind of thing. So how many more quarters would be requiring to get restructured or make your portfolio mix or advance mix, which you told in the earlier comment?
So let me answer the portfolio for profit per employee number has been impacted by 2 things. A, our total profitability for the quarter has dropped by 38%, as you're aware. B, our employee count has risen. So the mixture of the 2 has caused this. So as our, as the stressed assets that we have, flows through our P&L, and we revert to some kind of normality from a NPA point of view, and we go closer to an aggregate NPA, which is NPA accretion, which should be at the level at which we are accreting NPA for our commercial books, for instance, 59 books. And our P&L will look very different, substantially different, because our profit numbers will be different. So the profitability per employee will automatically increase as the current NPA problem sort of flows through. Coming to productivity per branch, this is something that we are working on. We think that we have a ways to go in terms of increasing productivity per branch. Currently, at peak, our productivity was roughly 136 crores of business, which is basically assets and liabilities put together. And because of aggressive growth in branches, that has been dropping. We have a model which basically shows that a branch sort of reaches 80-90% of its peak business roughly 24 months into the life of the branch. And now with the new tools that we are going to launch, we are hoping to cut that short to something like 15 months or thereabouts. So once that happens, I guess over the next 12 months or so, you should see this number going up quite dramatically. So that's the plan in any case.
And out of how many branches are break even, or what kind of break even does your branch normally takes? As you had opened 100 new branches, and due to that your OPEX had increased. So generally, what's the target?
The internal view is it breaks even in 18 and pays back in 3. So that's the metric to which we are working.
Okay.
There has been some divergence from that metric, and we are studying that. I don't have the statistic of how many branches are breaking even as of December, but we can, make that data available in the next deck to investors, if you think that is appropriate to have in this deck.
Okay. And last question on investor slide 22 on your advance category wise, which is there. Can you give highlight on your commercial real estate book, which is 6% of your total advance book? Any color on that, and been growing at 40% kind of thing? So what kind of rated book is that? And
this hasn't grown very substantially of recent times. It is just that from compared to December, it has grown. Against March, it hasn't grown really very dramatically. This includes the commercial real estate book. Also includes lease rental discounting.
Okay.
I suspect a large portion of this is actually lease rental discounting.
Okay.
Construction finance and actually finance that enables people to make commercial real estate will be a smaller portion. But it's a good question. We will try and get the details for you. We'll break this category out the next time around so that, we can address the question as to why is this relatively high risk segment growing. So we will break this out the next time around.
And your trading book, which has been grown at 30%, so in Tamil Nadu at a ground level, do you have found that once the GST has now been stabilizing, the working capital increase and it's going on, and what's the scenario at ground level in terms of the credit growth rate right now?
No, can you repeat? What is growing at 30%, you said?
The trading book which is there, which is normally for the working capital based kind of thing. So it's purely because on the GST part?
See, some of the growth is on account of the adjustment that is happening post GST. See, what we are seeing is historically lines that were unutilized are now being called upon and utilized. We are doing this is essentially because traders' working capital cycles have lengthened. So, especially on the commodity side, where they are one end of the transaction is on GST, the other end isn't, and settlements are taking longer than before. So that's one reason why this book has
so
grown.
It's a one-off, or this growth rate would be continuing at 29%?
No, we think that it will sort of taper off and actually start declining.
Okay.
And we will have to take care of that with new loans to traders. I mean, just to... the current spike in utilization will probably taper.
Okay. And what is the ground check on Tamil Nadu state in terms of the economic, because of the last quarter, this quarter there were floods, and in quarter three across consumer companies also had a phase that south, it had a rough patches. So how is the situation right now?
We see green shoots, and we see that there is reasonable buoyancy. We do note that the government of Tamil Nadu is not fiscally in a position where it can help industry very dramatically. But generically there is on the private sector side there is reasonable buoyancy. Textiles a big business in Tamil Nadu that is doing well. Apparently today they have announced that the refunds under GST for the textile exporters business is going to be forthcoming very shortly. That will address one large area of concern that the businesses here